Hey everyone, my name is Daniel and welcome back to the Finance Channel. I hope you're having a great day out there. As always, here today, I want to talk to you all about 5 stocks that I'm buying now, or not necessarily buying, but own within my portfolio. All these companies I'm very bullish on for the long run. I believe they're undervalued. I like their businesses, and I think they're going to be great investments that will really thrive over the next 3 to 5 years and potentially beat the market in a major way. But either way, in this video, I want to take you all through exactly what these companies are, what they do, my bullish thesis on them, and exactly what I'm doing with them moving forward. So if you end up enjoying this video and potentially finding some value in it, please consider subscribing. And with that out of the way, let's get into the video here. So stock number 1 on the list of Voyager Digital. This is the company that I talk about on the channel the most by far. Voyager, they are a cryptocurrency broker expanding into much more than just being a crypto brokerage over time. Currently, they differentiate themselves by allowing you to trade commission free. They make revenue off of taking a bit of a spread whenever you buy or sell baked into the price, similar to what Robinhood, Webull, and other potentially stock brokerages do. But on top of that, Voyager allows you to earn interest on over 30 of your holdings within their actual platform. They offer you to trade over 60 digital assets, 30 of which offer you interest through their lending program. They lend out these cryptocurrencies to larger financial institutions potentially in need of liquidity. Maybe they stake it, pocket the difference, but either way, you can earn a pretty large interest on things like Bitcoin, Ethereum, Polkadot, Cardano, or even USDC, the US dollar stablecoin. Voyager, currently a crypto brokerage, expanding into stocks by the end of the year, uplisting to the Toronto Stock Exchange, the NASDAQ in the next 6 months, or NASDAQ maybe early 2022. They're going to have margin, credit cards, debit cards, IRAs. They're going to have, everything you need to be a lifestyle financial app on top of payment processing through cryptocurrencies as the base payment, as the base currency. So when I look at Voyager, a company with a great business model and a very, very large moat, again, expanding into all of these different industries, wetting their toes in every single space in the fintech industry, which I really like. Now, looking at Voyager, this is a company that has been heavily correlated with the price of Bitcoin. Obviously, Bitcoin, the main cryptocurrency, it generally is almost like the S&P 500 of cryptocurrencies in the sense that if Bitcoin moves up, everything moves up. Voyager has been paired with that in the sense that Voyager makes money off of trading volume. The more buying and selling there is within the crypto industry, the more money Voyager makes. At the end of the day, that's how it works. If Bitcoin and other cryptocurrencies are moving up, potentially optimism around the industry, people are much more likely to trade. Voyager is much more likely to make revenue. So although a potential significant decline in cryptocurrency prices may be, a bit of a negative for Voyager as a company, I think the market has really overblown this fear to a point where, all right, it's discounted that, but on top of that, perception of everything that's been going on has caused a rather kind of significant continued decline here. So when I look at Voyager, this is the biggest position in my portfolio. They're at a market cap of, I want to say fully diluted, just around over 2.7 billion or 2.8 billion, maybe closer to 3. Again, this is just the shares outstanding. Got to factor in warrants, options yet to expire and turn into shares. It's, just under 3 billion at this point. But either way, in their most recent quarter, in Q2, this is April, May, and June, cryptocurrency volume went down the drain throughout the months of May and June. Significant decline. Elongated decline that has kind of just stagnated. Again, things have changed here over the past couple of weeks, leading to a potential decline in revenue month over month over month from, again, April, May to June. Either way, despite that, Voyager announced revenue of over $100 million, up from the $60 million that they announced in the first quarter when markets were favorable in the months of January, February, and March. This means that Voyager's account growth had outpaced the significant decline in trading volume, leading to a significant quarter-over-quarter growth despite that decline in trading volume. Hopefully that makes sense. Either way, roughly or just over 700,000 funded accounts, at least at this point, company growing significantly. And when you look at this revenue, sure, you look at it, right? And you're saying, hey, wait, they're trading at what? Potentially 10 times sales. You annualize this, that's roughly $400 million in revenue. You got roughly, again, a $3 billion market cap, so that's even less. You're trading at a price to sales ratio of just over 7 or just around 7, right? So you kind of consider this. Brokerages are inherently profitable. Voyager in the first quarter, off of $60 million in quarterly revenue, reported an operating income margin of 50%. That's ridiculous. After that, the main cost is taxes, and then you got net income. So at this point, Voyager is a company that can have net income margins of just under 40%. Again, making it a very, very profitable company, unlike some of the, maybe food companies out there, which do have lower margins. Voyager, a very high profit business at a 40% margin, let's say, which is very, very likely. You got, again, roughly a 7 price to sales ratio, and you're trading at just around 16, potentially 17 times PE, or kind of Q2's earnings, not pricing in any growth whatsoever. So I look at Voyager, growth is unpriced here. A lot of negativity around the stock, despite this kind of movement upward that we've seen since the kind of peak fear that we saw back in July. I like this one. There's a reason it's 40% of my portfolio. A lot of conviction here. And if you are new to this company, feel free to subscribe because I cover it pretty much on a every other day, every day. I make a video on Voyager, what's going on here, keeping track of it. Fundamentals continue to improve. Decline in share price is only an opportunity, at least in my opinion. Now, next stock on the list here, Smile Direct Club. This is a company that I've been secretly buying here over the past, I want to say, week or so. Went very heavy today. Obviously down roughly 24% after reporting earnings. If you don't know what Smile Direct Club is, they were a company that compete in a very similar space to Invisalign with the clear aligners. I'm not sure if you're familiar with them. An alternative to braces where you're able to take these clear aligners, potentially wear them just at night if you want, maybe throughout the day, 24 hours, and they, correct your teeth. That's what they do. Smile Direct Club, although they aren't, on the same quality as something like Invisalign, the cost is ridiculously lower. And from my understanding from the videos I've seen on YouTube, the reviews, a majority of them are kind of price comparisons show Smile Direct Club being only a quarter of the cost of Invisalign. Smile Direct Club have 75% gross margins, ridiculous profitability on that front. They're spending a lot on marketing to continue a significant growth rate that we have seen here. Up until 2019, COVID hit their business, and now a continued kind of negative cycle over the past year. Again, COVID resurging. They just missed on earnings and revenue and earnings because of their conference call. They described it, impact from COVID-19, a little bit higher marketing spending from Facebook because of the whole iOS situation and not allowing Facebook to track activity on other apps. But either way, you look at this company, they continue to execute. They have plans on 20 to 30% revenue growth over the next 5 years, which is, in my opinion, a very good possibility of them potentially overachieving that, and given historical data here, and expansion into international markets, which they say will make up for 75% of the growth opportunity at Smile Direct Club over the next 5 years. EBITDA margins aiming at 30%, which is similar to Invisalign. Keep in mind, this company, 75% gross margins, a ridiculously profitable business model on that front. But again, marketing to expand into those areas, increase brand awareness, and over the long run, it's just an investment into their future. So at a market cap of $2 billion, trading at well under just 2 times 2022 sales, which is just ridiculous in my opinion, given the growth potential at this company. And, it's a stock that's under a lot of pressure, right? So, does this keep falling? I'm not sure. I've been building a position now at around, I'm not going to say the exact number that is reserved for Patreons, which you can check out in the description down below, but it is a similar size rather to some of my mid-conviction stocks. Now, again, Voyager, Tattooed Chef, those are my big guys. Smile Direct Club, I can definitely build that into one of those over the long run. If the price does stagnate, potentially fundamentals continue to improve, maybe a further discount, either way, I like this one a lot. I think it's got potential. The valuation is there. And even if we do see a significant market decline, I do not think that Smile Direct Club will fall that much, given its already existing undervalued nature. I like this one. Let's see what happens here moving forward. Next stock on the list, Alibaba. This is one that I do have a small position in. I bought a little bit last week. And it's a company that not only has growth, but also has profitability. And on top of that is trading cheap. Obviously a Chinese company, you do have that risk that has been significantly priced into the share price of Alibaba here. Again, same as Smile Direct Club. significant decline over the past year here due to kind of risks and fears of it obviously being a Chinese company. Either way, market cap just over $500 billion. This company's trading at a forward PE of roughly 16, despite revenue growth being, well over 20% in, again, this year. Their fiscal year is actually 9 months ahead, I want to say, or our fiscal, yeah. So they just finished 2021. The first quarter of 2021 is the end of their 2021. Hopefully that makes sense. But either way, if this company continues this growth rate, optimism gets reinstated in the stock market around potentially Chinese companies. As long as they continue growing, that will be broken. This reminds me a lot of Facebook back in 2017, 2018. There was a lot of, they were under fire there from regulatory risks and whatnot. Either way, I like this company, involved in a very fast-growing e-commerce market within the Asian market, which in and of itself is expected to grow significantly and outpace any North American or European growth over the next 3 to 5 years here. So I like this one as, again, more of a safer valuation play, but you do have that risk of, again, it being a Chinese stock, limiting its exposure, at least in my portfolio personally. So that's my thoughts on Alibaba. I like this one. I think it's got potential. Next stock on the list, AcuityAds. This is one that I haven't talked about in a while here, but it's a big competitor to the Trade Desk. If you're not familiar with that, it's a company involved in the advertising space, taking your business, advertising it through potentially TV ads, connected TV, maybe online, different things along those lines. Now, the way they make money, they use their algorithms, they use their technology to increase the efficiency of each dollar spent to a point where they can now take a bit of a spread. Now with AcuityAds, their gross margins are roughly 50%. Now, over the past year or two here, roughly, they have really focused in on profitability. COVID did hit their business. Obviously, we can see that through, again, they are a Canadian company, something to keep in mind. All of their numbers, which they just reported here today, we'll go through this in a moment here, are reported in Canadian dollars. So when we look at the valuation, I'll just go through Canadian. All the ratios remain the same, though. On the NASDAQ, they're listed under ticker symbol ATY. On the Canadian Securities Exchange, the Toronto Stock Exchange at this point, ticker symbol AT.TO. You can see here, strong revenue growth leading up to 2019. COVID hit their business. They realized that. Instead of focusing on growth, spending as much money as possible throughout that, again, difficult time in 2020, they went ahead and focused on profitability to a point where they're now actually a profitable business, generating a positive net income over the past 4 quarters. A great thing to see from this business. Either way, they just reported earnings here today, roughly $30 million in revenue. They are transitioning to being more of a Shopify-style platform where, again, they're really democratizing the advertising industry, allowing small and medium-sized businesses to sign up for what is known as Illumin and make these different campaigns on their own while still having that aspect of increased efficiency. Now, I like this. This aspect of their platform was released back in late 2020, now generating $5.2 million in the second quarter of this year, 60% revenue growth quarter over quarter. This aspect of their business will continue growing, in my opinion, and will be a very strong driver of growth moving forward. Now, when I look at Acuity here, this is a business that, in my opinion, analysts are severely underestimating. Now, I keep going back to the NASDAQ listed one. Let's just go to the Toronto Stock Exchange one. Analysts only expect over 20% revenue growth over the next couple of years. And on top of that, don't really expect that much profitability. Roughly 25 cents in profit by, again, the end of 2022. When I look at this company here, and let's just take a look at this. When we look at their shares outstanding here, again, roughly 25 cents in profit expected by roughly the end of 2022 here. Let's just take a look at this. Shares outstanding, where is this? Roughly 60 million shares outstanding. Let's take a look at this. Look. You go 60,300,000 shares outstanding. Divide that multiply that rather by 25 cents, and you get analysts expecting roughly $15 million in net income throughout the year 2022. When we look at what this company just reported, they reported net income, from my understanding, of just around $3.3 million off of $30 million in revenue. So when we annualize $3.3 million, again, we can get rid of this here, annualize 3.361 million, multiply that by 4, you get roughly $13 million in net income. So when we look at analysts, they're severely underestimating the growth potential, not just on the top line, but also the bottom line when it comes to Acuity. Margins are going to continue expanding at this business as they continue to grow, as they continue to scale. So this forward PE of 45, in my opinion, is actually incorrect. We'll see what ends up happening over the next couple of potentially months, years here. I like this as an advertising plan. It is definitely a high conviction stock for me. I believe it will do very well in moving forward, rather, as the business continues to progress. Now, I do understand the stock was severely overvalued back in January and February. That's when I first heard about Acuity. I said, all right, valuation too rich for me. I'm going to wait it out. It has since significantly dropped, and I have been accumulating here over the past few months. I like this one. I think it's going to do great over the long run. Last stock on the list, the Tattooed Chef, ticker symbol TTCF, now trading at just under $22 per share. This is a company involved in the frozen food vegetable space. That's really the category. Frozen plant-based food space. That's the better way to put it. Involving aspects of innovation with, again, plant-based meats, things along those lines, but really building it into a meal-style approach where you got some frozen food, you put it into a microwave, you put it into your potentially your oven rather, and it's ready within a matter of minutes, 5 to 10 minutes. So not only is it potentially easy to make, it's plant-based, which is a major catalyst, or is something that will continue growing over the coming years here, rather. And on top of that, a majority of their food is actually kind of healthy, which is just the trifecta for millennials, which is really their target kind of demographic on that point. Students with college, whatnot. A company growing revenue significantly. We can see analyst expectations. Again, analysts are significantly underpricing growth, and you can see they just did a step up their growth estimates for 2021. This was originally at 220 million rather. I do think this business will outpace analysts, as again, when you look at analyst expectations for this upcoming quarter, roughly 54 million bucks in revenue. I mean, they just did like 52 million in the previous quarter. Yeah, 52 and a half. So, I'm expecting big things in their next earnings report here, a potential beat on revenue on that front, which in my opinion is very likely rather to come to fruition. Obviously, I can't predict that with 100% certainty, but this company continues growing, continues to execute, continues to make new products. Just today they announced, again, they're expanding into Sprouts Farmers Market with these new products, which I haven't seen before. They just released these. Expanding products, expanding stores, expanding within those stores. A lot of great things happening here. Very high conviction play for me. Half of my position, or not half, I want to say, again, just under 20% of my portfolio. A majority of that is in stock. Lesser majority is, or rather a minority of it is in long-term options 2023, expiring in January 2023. So when I look at the Tattooed Chef here, great business, great company, great management team, great sector. And I think they're going to have a lot of potential here over the coming years as they continue to grow their business to really expand into something much, much more than just a frozen food company, expanding into ambient products, refrigerated products in that sense, potentially snacks, other things along those lines. A lot of opportunity here for the Tattooed Chef. I've been buying it over the past, it's almost been a year here at this point. I've been following this since they actually, the pre kind of SPAC days, or when they were a SPAC back, I forgot what the ticker symbol was, but originally there was some rumor that it might be Impossible Meat, Impossible Meat, whatever, a competitor to Beyond Meat. Started following it. The Tattooed Chef turned out to actually merge with them, and that's how they went public. So, I've been covering this company, or kind of looking at it for a while now at this point. A lot of great things they continue to execute. Profitability next year, I think they're going to be a profit beast over the long run, given their kind of focus on branded products, or brand in general. That gives them pricing power and leverage over that kind of sort of thing. So, I like the Tattooed Chef. Let me know what you think in the comment section down below. This was a very interesting video to film. A lot of stocks, a lot of companies that I like, I enjoy. So let me know in the comment section what your thoughts are on any of these companies over the long run, what you think they're going to be doing 3 to 5 years down the road in terms of products, sales, revenue growth, profits, or even just stock price. Thank you all so much for watching, and I'll see you all in the next one. Bye-bye.